Have you ever looked at a rental property and thought, this feels like a good deal, but how do I actually know? During 22 years as a real estate investor, I've been there too. In this video, I'll show you the simple way I analyze a property. No spreadsheets, no fancy calculators, just a few quick numbers you can run on a napkin or an envelope. By the end, you'll know exactly how to tell a good deal from a bad one so you can buy rental properties with confidence. So the approach I use to analyze a rental property is something called back of the envelope analysis. So you might be thinking to yourself, are you really going to buy a property worth hundreds of thousands or maybe even millions of dollars with some scribbles on the back of a piece of paper? And all I can say is that many professional investors have a process like this, including Warren Buffett, the most successful investor of all time, who said this in a quote: if you need to use a computer or a calculator to make the calculation, you shouldn't buy it. And what he means by that is to know a deal is a good deal, whether it's in the stock market or a piece of real estate, it should be obviously a good deal, even with approximate numbers. So you don't need to get to the next decimal place or have a really fancy calculator to do fancy numbers to know it's a good deal. In fact, if you have to do all that, you might be trying too hard. It should jump off the page and be obvious because of the economics of it, because of analyzing it as a business. And that's really what I want to show you how to do today, step by step, how to apply this Buffett-like approach to a rental property, really whether you're a beginner or a more advanced investor. Real quick, if we haven't met yet, my name is Carson. You can also call me Coach Carson. I'm the author of 2 books about real estate investing, one called Retire Early with Real Estate, and the other called The Small and Mighty Real Estate Investor. And on this channel, I teach you how to use real estate investing to achieve financial freedom so you can spend your time doing more of what matters. In just a minute, we're going to get to some simple formulas you can use on your own rentals, but I want to start with an important question of why own rental properties in the first place. If you're like me, I enjoy the craft of real estate. I really like that we're providing affordable housing to people in our community and we're making a positive impact on our community, fixing up properties and keeping them nice for people. Those are all great and those are really important. But we also are doing this as a business. This is a financial investment. And so for me personally, I like to know that I'm building wealth with my rental properties. There's a financial component to it. And because I'm building wealth and I'm growing this income and this wealth over time, I can eventually get financial independence, the point where the properties pay for my lifestyle. Instead of having to go work a job and make a salary, you could optionally live off the rental income and have that support your lifestyle. And what that does for you is it gives you personal freedom. The motto of my channel is doing what matters because I like the idea of being a time billionaire. My family and I have lived abroad in Spain and lived in Ecuador. My wife's a Spanish teacher. And so we've been able to use the income and the freedom from rental property to do what matters to us in our life. You could do the same thing. And so I just like to keep that in mind because we're going to get into the formulas and the numbers, but really the properties have to be able to support us in doing all of these things and building wealth and having financial independence. So all of the analysis we're going to do in this video really answers one question: how does your rental property actually make money? And I like to think about rental property a lot like a rocket ship. You know, a rocket ship has these powerful engines that when they're ignited, they take the rocket ship out into outer space. And a rental property is kind of similar to that. I found there's 2 main profit engines that can accelerate your rental property to helping you achieve your financial goals. The first one is the income of the property. So you collect rent, you pay your expenses, and hopefully every month there's something left over. That's the cash flow that you can put in the bank. But then number 2, there's also this component of equity growth. This is another engine. And there's a couple ways to think about that, but you could think about it like you've heard of buy low, sell high. So a property is worth one thing, but if you buy it below that value, you can actually buy some equity today. That could be a profit engine. You can also do something to the property like fixing it up to increase the value, or you could hold on to it over time, buy and hold real estate, and the property kind of grows slowly, but over time. And you can also pay your loan down. And we're going to talk more about these details. But all of the formulas that we're going to cover are going to be measuring one of these 2 profit engines. And there is another profit engine that a lot of people talk about in real estate called tax benefits. Definitely an important one, but I like to focus on these 2 because policies can change, politics can change. So tax benefits to me are kind of like the gravy. You take advantage of them, but you don't want to do a deal just because of the tax benefits. So let's zoom in on one of those 2 profit engines and talk about how do you analyze the income of a property. So I'm going to go through multiple formulas here that help measure income. And you might be wondering, like, Chad, why do we need to have all of these different formulas? Isn't that a little confusing? And I like to compare this to if you were to go buy a car, for example, and as a car you knew nothing about, you would probably want to pop the hood of the engine. You probably want to look at the trunk. You probably want to crawl, kind of go underneath the car. You want to look at the inside of the car, the outside of the car. The point is you want to look at it from a lot of different angles, and you want to maybe have a friend friend help you analyze it as well. And so that's really what these formulas do, that a deal is too complicated just to look at one thing. And so each of these formulas evaluate a rental property from a little bit different angle. And by having the complete picture of all of these, it can help give you a better idea of whether it's a good deal or not. But what you'll find is you'll kind of gravitate towards maybe one or two of these formulas as your main go-to formulas that tell you whether it's a good deal or not. And that's okay. And as I give you more examples, you'll kind of get the idea of which ones matter the most. But the formulas we're going to use are, number one, something called a rent to price ratio. You might have heard of something called the 1% rule, which is a special version of the rent to price ratio. I'll show you how that's kind of a rule of thumb to quickly analyze properties. And then we're going to go more in depth with two different kinds of formulas. One is going to be analyzing a rental property with no debt. So we're going to assume the property, even though we use mortgages a lot in real estate, we're going to assume that the property doesn't have any debt. And we're going to look at something called the net operating income. And we're going to look at something called the unleveraged yield, also called a cap rate. And these are two different ways of looking at a property with no debt. One on the amount of cash flow or income you have, and the other on the rate of return. And then we're going to do the same thing analyzing a property with debt. So if we're going to use a mortgage for the property, we want to know how much cash flow is this property going to make when we have a mortgage. That's also known as net income after financing. And then we're going to look at something called the cash on cash return. Speaking of cash on cash return, some investors have this as the most important formula they look at. And with interest rates higher and the cash flow harder to come by, they've been frustrated where not as many deals meet their goals for cash on cash return. And what I'll say to you right now is cash on cash return is actually the least important of the formulas that I'm going to share with you. And so stick around and I'll tell you why it's not as important for me. By the way, we're going to be covering a lot of formulas in this video. So if you want to follow along or use these to analyze your own rental properties, I've got a free cheat sheet you can download. If you're watching on YouTube, you can click on the link at the top of the screen. Or if you're watching on YouTube or listening on the podcast, I'll have a link in the podcast and YouTube description below. So the first formula I want to talk about in the income analysis is something called rent to price ratio. And this is really a higher level analysis. You're really not getting into the details of the actual expenses of a property, but it's something that a lot of investors like myself use as a quick first pass, either a quick first pass of the market or of a list of properties. Like if my real estate agent sent me, 3 or 4 properties, I might look at the rent to price ratio because I can do the math really easily just by looking at them really quickly. So it's a quick rule of thumb formula. And here's how it works. Let's say you found a property and you're in a cash flow market. Maybe you're looking at Memphis, Tennessee, or somewhere in Ohio, and you find out that the property rents for $1,500, and you do an analysis of the value, and you figure out that it's valued, or maybe the list price is at $175,000. So you just take $1,500 divided by $175,000, and you get 0.0085 or 0.85%. So you would say the rent to price ratio is 0.85%. Or maybe you go to a really expensive market, and many of you live in those areas, and you say, well, the same house there rents for $3,000 per month, but I'd have to buy it for $900,000. How's that going to work? And so what's the rent to price ratio of that really expensive property? Then it would be $3,000 divided by 900,000, and you get 0.0033 or 0.33% rent to price ratio. And so this sort of shows you how it's used in a general sense. Is way you can compare different markets on how good they are at producing cash flow. That's really what the measure is. The higher the number, so the closer you get to, for example, the 1% rule, the better that market is at producing cash flow. And if you're in a market where it has 0.33%, and that's the typical property, then you're not going to be easily cash flowing properties unless you make a really big down payment, or you do a different kind of strategy, or you buy it at a huge discount, which is not usually realistic. And so it's going to be a harder market to make cash flow in. That's really what this tells you. And so you can use it to filter markets. You can use it to filter properties quickly. And a lot of people have used the 1% rule as a quick rule of thumb to say this is kind of a cutoff point, and there's not absolute for every single property, but it's a cutoff point where if it meets the 1% rule, it might be a good cash flow property. And so, for example, let's say take this same $1,500 rental. If you have $1,500 per month, and to make it meet the 1% rule, you would need to buy that property, even though it's worth $175,000, you need to find one that you could buy for all in $150,000 instead of $175,000. In that case, it would meet the 1% rule. Obviously, these other ones don't meet the 1% rule. Now, does that mean that every deal that meets the 1% rule is a good deal? No, it doesn't. That's why we have multiple formulas. And it also doesn't mean that any deal that doesn't meet the 1% rule isn't a good deal either. There are multiple ways you can make money. Remember, you make money with income and you can make money with equity growth. But the point is, income is going to be a little bit harder. It's going to be a lower return of income if it doesn't meet the 1% rule or if it's lower than the 1% rule. And so this is just a way to kind of quickly be able to judge that before we get to some of the other formulas, which I want to talk about next. So the next formula for income analysis is something called net operating income. You might see this abbreviated as NOI. And I think this is the most important formula in all of rental property investing. And I'll explain why. It tells you the amount of income, the amount of cash flow your property would make if it had no debt on the property. And you might ask, well, Chad, most of us are going to use debt to buy a property, so why would you analyze it without debt? And the reason is every investor uses slightly different debt. Some people put 20% down, another person puts 40% down, another person pays all cash, and every debt's a little bit different. So you might have a mortgage with a one interest rate, another one with a different interest rate or a different term. And so if you really want to compare property to property and be able to compare apples to apples, then it helps to not include the debt, at least to start when you analyze it. So I do this on every single rental property that I analyze. And the way NOI works is it takes your gross rent, and if you're brand new to rental investing, that doesn't mean disgusting rent. That means the total rent that you expect to collect, and you subtract all of the expenses you might have except for your mortgage expense. And so it includes things like a vacancy expense. A vacancy means you expect not to collect that rent 100% of the time. So I'm in a college town, so about 50% of my rentals are college student rentals, and they turn over about every year and a half. And so we average about every time it turns over about 10 days of vacancy, and it comes out to about 4% of the rent we expect to collect is gone to vacancy. And so you need to put some sort of vacancy, and you can determine what that means for you, but usually 4 to 5% is a good starting number. And then you also want to include operating expenses. So these are things like taxes, property taxes, insurance. And so even if your mortgage has an escrow in it, you still include it in this analysis of the property. So you still take out your taxes and your insurance. You want to take out a management fee. Even if you're managing the property yourself, that's great that you're making that money. But if you want to be working for that property forever for free, then you need to actually include a management fee, because you could hire a manager down the road. So if the property only works with you doing it for free, then it's not necessarily a good deal. So I would, even if you manage it, include the management fee. You also include things like maintenance on the property. So things break. When people turn over and between tenants, you have to paint the property or do some cleanup. You also have capital expenses, and those are things like the heating and air, the roof, major systems, the driveway. Eventually those things break. It might take 50 years for the driveway, for example, or maybe 15 years for your heating and air, or 25 or 30 years for your roof. But if you buy a property where those things are already old, you could have a big $10,000, $15,000 expense on some of those, right away. So you need to account for those when you're doing your analysis of the property. And so you might ask what all of those are. I have another video that I'm going to have a link to in the podcast and YouTube description below, where you can check out my actual analysis of a real property to see what some of the real numbers that I use in a rental property might be. And I broke down step by step. But I want to give you a couple of examples, just kind of rough math on what this might look like to figure out the NOI for a property. So let's say we have on a low end, like a cash flow type property. Maybe this is in a part of Ohio again, or in Memphis, Tennessee, or somewhere where the rents are a little bit less, or the prices are a little bit lower. Let's say I had $1,300 per month in rent, and let's say that the operating expenses, all the vacancy operating expenses, is about $600 per month. So if that were the case, $1,300 minus $600 means I have a $700 NOI on that property. So let's do a different price level of property. Let's say I have one that rents for $2,000 per month, and I have $800 in operating expenses. This is a real number on a property that I have, so I'm very familiar with this kind of ratio. And so my NOI would be $1,200 per month, or $14,400 per year. Hopefully I did my math right on that one. And for $700, that is $8,400 per year. So what do we do with this? This, number one, just tells us how much money or how much income we're making on an annual or a monthly basis. But then we can use it for the next formula, which is very important for me as well. It's called the unleveraged yield, or a cap rate. So if the net operating income is the most important number in rental analysis for me, then a close second is this formula called the unleveraged yield, which is also the exact same formula, just used in a little bit different way as a cap rate, which you might have also heard. So remember what we're doing here. We're analyzing the income of a property without debt, and the NOI told us how much income we're going to make without debt, and the unleveraged yield tells us our rate of return without debt. And so let me show you the formula. You just take the NOI that we just figured out in the last formula, and you divide it by the total cost of that property. And by total cost, I mean the price of the property. That's probably the biggest part of your cost when you pay what the price you pay for it, but also includes the remodel cost, the rehab, if you're fixing up the property, the closing cost, the holding cost. You want to figure out all of the costs that you have in buying this property so that you can figure out your total return. And so let me give you an example. Let's say going back to our $1,300 rental, that remember that property had a NOI of $700 per month when you subtracted your $600 in operating expenses, or that was $8,400 per year. And for this formula, you want to get it to an annual number. So $8,400 per year divided by, let's say we had $130,000 in total cost. And I'm picking that number carefully because remember, review here, we talked about the 1% rule. This deal, if we could buy it for all in $130,000 and it rents for $1,300, it would meet the 1% rule. So let's see what the equivalent unleveraged yield or cap rate is for a 1% deal. So in this case, $8,400 divided by $130,000 equals 6.4%. So I have found that typically deals that meet the 1% rule, it's going to depend on what their actual expenses are usually anywhere from 6 to 7% unleveraged yield. That's the equivalent number for a 1% rule. But then you also look at other deals. So let's do a quick analysis of an unleveraged yield on maybe something that'd be more typical in my area in Clemson, South Carolina. So we had that $2,000 rental. That remember, it had operating expenses of $800, has $1,200 in NOI per month, or $14,400 per year. And so that's the first part of our unleveraged yield formula. But we're going to divide that by, let's say, $350,000. That would be the full value of that property that we could buy retail today. So $14,400 divided by $350,000 equals, I believe I did my math right, is about 4.1%. So that is the unleveraged yield, or the cap rate for that property in these two different scenarios. And so the question now is, just like with the 1% rule and the rent to price ratio, what is a good unleveraged yield? So the answer to that really depends on the location of the property and also the type of property you're buying, because different locations and different types of properties have different risk levels. And so you can see a chart here that kind of explains this, is that you see New York on the top and Detroit on the bottom, and then we have three different types of locations within each of these areas. This is some data that I pulled from Newmark North America. They're a commercial real estate data company. And as you see in New York, which is a stronger economic area than some of the other ones here, Detroit on the other end. Not that any of these are bad cities to be in or invest in. In fact, some of the ones that are lower on this chart might be more opportunistic. You have more opportunities for us as small and mighty investors. But just looking at New York, there are investors who are willing to buy properties and get a 4.25% cap rate or unleveraged yield in the Class A, the best district in New York. And in the same investors who are willing to buy in New York would only accept a 6% cap rate or unleveraged yield in a Class C area, because they perceive that either to be riskier in that area, or there's just more demand for the Class A and less supply. And so this is all about pricing. This is all a market. And so the supply and demand is different in different areas because of risk, but also because there are investors who just have different reasons for buying. So why would somebody buy at a 4.25% cap rate in New York? Well, I'm just speculating here, but they might say they feel like that's a much more secure income stream. They feel more confident that they're going to get that than they are getting it in Detroit, for example. Or they might also anticipate that there's going to be growth there, that maybe there's going to be more growth in New York City and the prices there and the rents there than there will be in Detroit. So it could be security, it could be growth, but these are rational investors who are choosing to put their money in a certain area. And this works the same way in other markets, like people are willing to buy U.S. Treasury bonds with a 3% return or 4% return. But if they're investing in stocks, they want to make sure they're getting like a 9% or a 10% return. And so it all has to do with the level of riskiness of those investments and the supply and demand. So what does that have to do with you? you have to make a goal for yourself, and you have to choose where you're going to invest. And this is another topic for another day, but you have to choose a region you're going to invest in. You have to choose neighborhoods you're going to invest in. I have a whole video on choosing your buy box, which is one of the most important first steps as a real estate investor. So check that out. I'll have links in the podcast and YouTube description below. But I'll give you just an indication of kind of what my market looks like. I'm in a suburb of Greenville, South Carolina in the upstate. I'm halfway in between Atlanta and Charlotte. So it's kind of an outer market. This isn't a core market, but I'm in a college town. And you can see a little map here. And within that college town, I have Class A locations that are the best locations near the campus, where they're the most expensive properties in town. There's Class B locations where a lot of my properties are now that I own, some small multifamilies and single family houses. And I have some properties in Class C locations, which aren't necessarily bad. They're just like more blue collar locations. I define them as like a mix of rentals and owners. So maybe 50-50 renters versus owners. But for me, when I'm buying in my location, if I can buy in a Class B area and I could buy a single family house, I might be buying at a 5% to 5.5% cap rate in that area. And if I'm buying the same exact property in a Class C location, I might expect to get a 7 or 7.5% cap rate, unleveraged yield. And so this determines what I can pay for the property. So when I'm using these formulas and I'm running the numbers, I'll use this as a goal and say, in my area in Clemson, South Carolina, I don't want to buy a property if I can't get a 5 to 5.5% single family house in a Class B. And I might say the same thing, single family house in a Class C, I would want a 7 to 7.5%. And that might be a little higher for a duplex or a multifamily property. I might need to make a 5.5 to 6%. And so you have to set your own goals for those. You can borrow some from me or from other investors just to start. But this is the way I use an unleveraged yield to create a goal for myself and to be able to analyze a deal that I'm considering buying. So remember what we've done so far. We're doing a back of the envelope analysis of a rental property to tell if it's a good deal or not a good deal. And we can look at the income of the property, the equity growth of the property, which we'll get to in a minute. And so far with income formulas, we've just looked at the rent to price ratio, the net operating income, and unleveraged yield. But we haven't done any of these formulas as if we had a mortgage on the property. And most of us are going to be using a mortgage or debt to buy the property. So this first formula that I want to go over is just the cash flow of the rental property, how much cash flow you're actually going to make. And some people call this the net income after financing. And the formula is really simple. You take the net operating income that we already figured out how to cover, so that's the rent minus all of your operating expenses, and then you finally subtract your financing cost. Now, something I want to mention here with financing cost, very often when you get a 30-year mortgage, some of you might have an escrow in that financing cost. So that's what's called your principal, your interest, and then also your taxes and insurance can also be put into that escrow. For the purposes of this formula and the way we're doing it here, you want to leave any escrow payments out. We don't want to count that twice. We've already counted that taxes and insurance in our NOI calculation. So for now, you just want to figure out what's the principal and interest payment of my financing. And to start doing that, let me give you an example. Remember our $130,000 property that we were going to buy like in a more cash flow centric market? Let's say that you put $30,000 down on that rental property. So if you put $30,000 down, you bought it for $130,000, then you had to borrow $100,000. And I want to give you a couple of assumptions here. Of course, it's going to depend on when you're watching this and what kind of loan interest rate you can get. I'm going to assume, just to make things simple here, that you could get a 6% interest rate, and it's going to be a 30-year mortgage. And I want to figure out what is my payment on a mortgage like that. And this is not something you can do in your head, back of the envelope. So this is an example of using a calculator, but I actually have a free amortization loan calculator on my website, which I use all the time. You're welcome to use it as well. I'll have a link in the YouTube and podcast description. And right now I want to show you how easy it is to figure out your payment on a loan like this. So basically what you do with an amortization or a calculator or a loan calculator like this one you see on my website is some of the things already, like that you could get a 6% interest rate because you've gotten a quote from a lender perhaps. You've looked online to figure that out. You always want to have 12 payments per year. That's a typical loan that we use. And then for a 30-year loan, you want to have the number of payments as 360. If you were doing a 20-year loan, that's 240. 15-year loan, that's 180 payments. And then what we want to figure out is the amount of the payment amount. So we're going to put our loan amount here of $100,000. That's what we figured out after we put $30,000 down. And so you always leave one of these blank. The balloon payment usually put 0 or leave that blank. But when you have these other 4 numbers, you can leave payment blank, click calculate. Actually, I'm going to click show amortization schedule as well. And let me leave that blank. There we go. So your payment's just under $600 per month. And if you want to dig into like other details, it'll tell you how much your annual payments are, how much interest you pay over the total life of the loan, and then you can look at a year by year, month by month amortization schedule. So that's what this calculator shows you. But let's go back to the whiteboard and I'll show you how you can actually figure out your cash flow. So now that we know our payment was approximately $600 per month, let's go back to our rent. Remember, our rent was $1,300. We had $600 in operating expenses. So our NOI was $700 per month, $700 NOI, and our mortgage payment is $600. So if you subtract our financing costs from our NOI, we get $100 per month of cash flow, or on a yearly basis, that's $1,200, $1,200. Let's do one more example just to help this sink in. Remember our other example, we had $2,000 per month was the rent. And remember, we had a value of $350,000. So I'm going to do this one a little bit different. I'm going to go in reverse to figure out how much would I have to borrow in order to just break even on my cash flow. So the other example, we started with the purchase price and had a down payment, and then we knew how much we were going to borrow, and then we had to figure out our payment. I'm going to do it in reverse. So remember, we had $800 in operating expenses was the amount of taxes, insurance, maintenance, things like that. So we had $1,200 per month was our NOI on this other rental property. And so the question is, if I want to make at least a break even, so maybe this is a higher price property and I'm like, I'm not going to make a ton of cash flow, but at a minimum, I like the location, but I don't want to have a negative, I don't want to have an alligator where it's eating all my cash flow. So at a minimum, I want to have a zero break even cash flow. I'd like to do better, and we'll talk about how you can do a little bit better in a moment. But let's say, what kind of payment would I have to have? I'd have to have a $1,200 payment in order to break even on this property. So what I want to do, I want to go back to the amortization calculator, show you how to figure this out. If you start with the payment, the thing I'm going to be trying to figure out is how much could I borrow at 6% interest over 30 years and still have a $1,200 payment. That's what we're going to figure out. All right, so we're back to the calculator on my website, and we're going to leave the payments the same as still 360 payments or 30 years, still 12 payments per year, still 6% interest rate. The thing I don't know is how much we can borrow, but I do know that I want to make sure my payment is $1,200 per month. So now I'm going to calculate to figure out how much I can borrow. And the most I can borrow, just round numbers, is $200,000. So to get a $1,200 payment, I could borrow 6% interest, 30 years, a $200,000 mortgage. Now, what does that tell me? As I'm negotiating, this is how you can actually use these formulas. You can go and look at this property. It's like, all right, it's listed for $350,000, or maybe there's an equivalent property down the street that's a fixer-upper and I could buy it even cheaper. But you know that if you're going to buy it for $350,000, in order to have a break-even cash flow, how much are you going to have to put down? $350,000 minus $200,000, which is our loan amount, is $150,000. Now, some of you are going to be saying, that is a huge down payment. That's ridiculous. Why would I put that much money down just to get a break-even cash flow? And you might be right, questioning that a little bit. So maybe this is where you negotiate. This is where you say, well, that's not quite a good enough deal. Maybe I want to buy the property at $300,000. Maybe I negotiate. Maybe I make a lower offer. Maybe I find a fixer-upper property that I can buy cheaper. Maybe you're even able to get a deal at $280,000 all in. Like this is like the norm of real estate investing. Is that a few years ago we had these really low interest rates, and it was easier to buy a property at full price and get a 4% interest rate and still make it cash flow. But the thing is, the way we are in today's market, we're back to the normal historical market where it's not easy to cash flow when you just buy rental properties at a pay full price. You've got to do something a little bit different. And so in this case, what I'm saying, I'm getting a little ahead of myself with equity growth. You might need to buy the property at a discount. So if you bought it at $280,000, and not every person is going to sell their $350,000 for $280,000, you're going to have to do some deal finding and some looking around and find some properties that, a seller might be a little bit more motivated or it needs work. But if you could buy all in for $280,000, then you could put $80,000 down instead of $150,000 and still have a loan that breaks even. And we're going to talk about it in a minute and how equity growth works. If you're buying at $280,000 and it's worth $350,000, you could also sell that property in the future and make a profit. And so this is where the multiple forms of profit come in, and not just cash flow. Like if you get stuck on cash flow and you just say that's zero cash flow, or this property is only $100 per month, how am I going to get financial independence at just $100 a month? If I want to make $10,000, that's a lot of properties, right? In order to get that much money. But that's a little bit short-sighted, and it's not thinking about the long run. I had a property that I bought in 2009 that made $50 to $100 max per month in cash flow. but that was 2009. I've held onto this property and my mortgage is fixed, just like we're talking about here. And that $50 to $100 per month has now grown into $800 per month because my mortgage payment is exactly the same as it was back in 2009, but the rent has gone from $950 up to $1,650 or $1,700. That's the kind of market rent at this point. And so I'm making a lot more cash flow. And that's really the difference between looking at your rental today in the cash flow and anticipating that if I could hold on to it in a good location and it can grow over time. That's the buy and hold strategy where things get better and better and better, especially if you can make it make sense and buy in a good location. And that brings us to the final formula for income analysis called cash on cash return. And this is the formula I like to use with some of the other formulas. I don't usually look at it by itself, but it's a really simple formula. And it is just the cash flow, which we figured out in the last formula, divided by the total amount of cash invested. And I say here cash invested instead of down payment because it does include your down payment, which is usually the biggest amount of cash you put into the deal. But you also want to remember sometimes you have to fix a property up and add extra money for repairs. So you want to include that in your total cash invested. And you also want to include any other costs like financing costs, maybe some holding costs. And so you want to add, sometimes those can be in the thousands of dollars as well. And so I'll give you an example using our kind of lower price cash flow centric property before. Remember we had $1,200 per year in cash flow from our last formula. And we want to divide that by the amount of money we put into the deal. And so we had that as a $130,000 purchase. We had a $30,000 down payment. Let's assume this is like a turnkey property is already fixed up, but we have another $5,000 in financing costs to get it bought. So our total cash invested is $35,000 in this case. And so we just divide $1,200 by $35,000 to get our cash on cash return. And I did this ahead of time so I can know the number. That comes out to 3.4%. So not a huge number. That is not a big cash on cash return. But I want to tell you a couple of reasons why cash on cash return can be a little bit misleading. It's definitely good to know what your return is on a deal. But for one reason I don't like it is you can get really high cash on cash returns that are a little misleading. So for example, what if you had $1,200 per year coming in, but you only invested $3,000 down for some reason. You had a really creative deal using a lot of leverage. And you might automatically say, if that was your main thing, you would say, wow, that's like a 33% cash on cash return. And that's really good. But it's not that much money. You're making $1,200 and it's really good because you put just a very small amount down and you borrowed a lot of it. And so that could be more risky and a little bit misleading that it's a really good deal. But really, the other reason is a lot of people, if you just pass on a deal because it has a low cash on cash return, and that's very common right now. Most deals, even the cash flow deals in like lower price markets, are anywhere from 3 to maybe 5% cash on cash returns, or what I'm seeing right now. Like even on the decent deals, the good cash flow deals. So if you're doing a deal that is not in a cash flow market and putting a much larger down payment, you might see 1 to 2% cash on cash returns. And so why would you do a deal? That's the question you should probably ask yourself. Why would I do a deal if I have such a low return? Because isn't the point to get a return on my investment and to grow my wealth and do all that? And yes, it's true. But cash flow is not the only way you grow your wealth. And so that's the point I want to make. I've evaluated a lot of properties that I've bought, and here's a little pie graph. And when I look at the last 10 to 15, 20 years of all the money those properties have made me, cash flow, even on my cash flow properties, the ones that seem to make a lot of cash flow up front, it might be like 10 to 15%. The debt pay down on the property might be another 10 to 15%. But then, 70 to 80% of the wealth I built on those properties were from the equity growth, from doing other things like buying the property low, doing something to the property, or the property just appreciating over time has been from the equity growth in the property or the price growth of the property. And so that's what I want to talk about next is how do you actually measure that? Because your total return is what matters. Yes, cash flow matters, but also some of these other things matter as well. So we spent a lot of time on the income analysis formulas, but remember our metaphor, our rental property is like a rocket ship. And in order to get into orbit and to meet all of your financial goals, there's really only two engines that are going to get you there. There is income and there is equity growth. And that's the big takeaway I hope you have from this entire video is that when you're running the numbers, when you're doing a back of the envelope analysis, if you're not making a profit or you can't show yourself that you're meeting your goals from one or both of these, then it's not a good deal. And then so you have to pass. And so this is really about using these rough measurements to tell yourself whether it's a good deal or not. But what I find often happens as a beginner, I know for myself, it was pretty easy to figure out the income. There's some learning, it's a little bit of basic math to get, but I would also often pass on deals that were actually good deals because I missed on this other opportunity called equity growth. So before I talk about how you find those deals that have equity growth, the first thing I want to define is, what does equity even mean? And you might have heard of this as a financial term, but this is really simple to understand if you think about a rental property. And so I have a picture here of what's called a balance sheet. And on the left side of the balance sheet is the asset. This is what you own. And so think about our rental property example we've been talking about. Remember, we had a $350,000 house. That was the full value of this property. And that's what we paid for it in the simple version of this example. And so on the left side of the balance sheet, you just have $350,000. That's the full value. That's how big that asset is. But because it balances on the right side of the balance sheet, it always has to equal the left side. And so the question is, how do you buy this property? If you buy it for $350,000, where does the money come from in order to pay for that? And so in this case, we had an example. Remember, we had a $200,000 mortgage. And so our debt, or our liability on this side of the balance sheet, is $200,000. But remember, it has to balance. So we have $350,000 on the left, $200,000 on the right. The difference between the money we borrowed and the value of the property is our equity. That's actually what we own. And so in this case, we are doing this as a rental property, and we're putting a down payment. And so our down payment was $150,000. So $200,000 loan, $150,000, that equals a total of $350,000. And so that balances out. So that's the concept. If you get a down payment, you understand what equity means. But the big question here, and really the key to understanding how to make more money in rental properties, is how do you turn that $150,000 down payment into something a lot bigger? How do you build wealth so that's worth $400,000 or $1 million, and so that you can eventually have financial freedom? So I want to explain a few different ways you can grow your equity. So the first way you can grow your equity is to buy a rental property at a price discount. And so remember our example earlier, we had the full value of a house was $350,000, but you were patient and you negotiated and you found a good opportunity and you were able to buy it for $300,000. That's a $50,000 discount, or about a 14% discount. And the way to think about that is that's like going to Walmart, and every once in a while, there's a sale where you can buy something at a discount. Now, this doesn't happen every day. This doesn't happen to every single property, but with thousands of properties out there and thousands of people and situations, there's some people who are willing to take a discount. Maybe it's 2%, maybe it's 5%, maybe it's 10 or 15%. And I'll be honest, I've been in situations where I've had a day and a property and a situation where I'm like, if somebody comes along and makes me an offer, I will sell it at a discount too. So this happens. This is just part of being a human being. And if you're patient, you can find deals and you can make yourself a goal. Like I might make myself a goal to buy a property at 10% below its full value. That could be one of your goals for buying a nice property in a nice location. And maybe you grow to even get it even at even more of a discount at 20%. But let me show you what that means from an asset standpoint, how you grow your wealth by doing that. Because you have this property that still is worth $350,000. That's the full value of what this property you own. And let's say you get a $200,000 mortgage, just like we talked about before, to buy the property. But because you bought it for $300,000, so 300 is the full value on the left side. You got $200,000 mortgage. You're able to put less money down. So your equity that you initially put into the property is $100,000. That's the difference between the $200,000 loan and the $300,000 value that you paid for the property. But then a month later, if you turned around and wanted to sell it, this property is worth $350,000. So the actual asset you have is worth $350,000. You still have a $200,000 loan, but because that asset is worth more, your $100,000 equity is now worth $150,000. So the difference between $350,000 and $200,000 is $150,000. So basically instantly, because you've negotiated a lower price, your equity has grown from $100,000 to $150,000. And that's just because you bought it at a discount. But there's other ways to think about this as well. Price discounts are one way, but I had a mentor who told me that some of the best real estate deals are like buying good dogs with fleas. So literally you could buy a house that has fleas. That might be one problem that a house would have. But in general, what I'm talking about here is if there's a problem with the property, a problem with the zoning on the house, there's an opportunity to change something about the property. That's called forced appreciation or adding value to the property. And this is the classic fixer-upper house. If you see a fix-up and flip house, or you see the BRRRR strategy where people buy it at a low price, they fix it up and they do something to it, that's another example of adding value. But there's many, many ways you can do this. You can also rezone properties. You can also, I just bought a property recently where we had a lot. We actually had 2 lots, and the house is on one lot and there's an empty lot next to it. And the house was just a big fixer-upper. We decided to tear the house down, and then we knew the zoning underneath it allowed us to divide those 2 lots into 3 lots. And we now have 3 buildable lots, and we're going to build 3 houses on those lots. That's a little bit more advanced example, but that's another example of adding value and forcing the appreciation of the property. So some of your best deals in real estate come from you being willing to add value to a property. So you might buy a property for $250,000 that by putting $50,000 into it, so maybe you have $300,000 total, could end up being worth $600,000 because of all the work you've done to it or the changes you make to it. And so the biggest equity growth you can make in real estate, there's also some risk to it and some work as well, can come from adding value deals. And what I want to say about this is that there are some deals where the cash flow on the surface on the front end doesn't look that great. You might have a low cash flow or low cash on cash return, but if you haven't put it through the filter of equity growth, you might not realize that's actually a good deal. And I've passed on deals in the past that I didn't realize were good because I wasn't applying this filter. So we have a price discount, we have adding value. Those are the 2 active entrepreneurial ways to grow your equity. And so you have to evaluate that when you're buying a rental property. But there's also 2 other more passive ways to grow your equity. And the first of those is just passive appreciation. So remember my example where I bought a property that had a $950 per month rent. That same property at the time I bought it was worth about $160,000. And I'll be honest, it wasn't a great deal for me. Like, I didn't buy it at a big discount on the front end. I had about 160, maybe 165,000 invested in it. So not a price discount, but I held on to that property and I got good financing and is in a good location. And today that property, as I mentioned earlier, rents for $1,650. I think we could up the rent a little bit from there. Is making a much bigger cash flow. So it's had passive appreciation of the rent. It's also had passive appreciation of the value of the property. The $160,000 has grown into about $280,000 to $300,000 in value. And so my mortgage has paid down. That's number 4, that I have amortized my loan just by me collecting rent and making that $400 mortgage payment every single month. Instead of owing $120,000 that I originally owed, it's more like $60,000 now. And so I built equity, $60,000 in equity just by collecting rent and paying the mortgage. We built another amount of equity, almost doubled the value of the property, a little bit under doubled by just holding on to it and the price going up, and then the rent has gone up as well. And so these are the ways over time, if you can hold on to properties, be patient, be a buy and hold investor, you can build a lot of wealth just by both a passive approach and, if you want to get more involved and more active, by an active approach. These are how some of the big amounts of wealth are built in real estate. And so that's why you have to balance it with the income analysis. You have to balance it with the equity growth analysis as well. So I want to take everything we've covered and put it all together and help you apply it to your own rental properties in your own market. And if you'll let me be your coach for a little bit here, the best way to learn anything I have found is to practice it and to take it from the concept and actually do it yourself. And so I have some steps here to help you apply what we've learned today. And the first step is just to set yourself some good deal goals. So what does it mean for you to have a good deal? And if this is brand new to you and you've never done this before, it's okay just to practice with a couple of ideas that you've borrowed from me. So maybe you tell yourself that I want to have a 10% discount on a deal and I want to have an unleveraged yield of 6% and some cash flow of $100 per month. Those would be example goals you can set for yourself. I'm not saying those are the ones you should use, but I tend to use unleveraged yield. I tend to use a price discount. And I like to have a certain amount of cash flow. So you could start with something like that. Those are 3 different goals. And then just go find a property. Look on Zillow, look on Redfin, wherever you can find a property. The point is that you might not be buying this property. You're just practicing the evaluation and you're going to go gather some data. So you're going to have to gather rent data. And there's never been a better time now with all the online data we have. You can go to Zillow and get Zillow rent estimates to be able to estimate the rent. You can go look online at your tax assessor to figure out what the taxes are. You can go to one of my sponsors of my channel to to get insurance quotes through Steadily. And these quotes are a lot easier to get than they used to be. And so you're going to have to put some data together to gather data to figure out what the income snapshot is. And that's what I want you to do, is put a snapshot, all the things we've covered, to figure out the rent to price ratio, to figure out the net operating income, figure out the unleveraged yield, and just use a piece of paper, use a whiteboard digitally if you want to do that. Or if you want to use a spreadsheet, that's okay too. But the point is, you're going to create a little snapshot, almost like you're taking a picture of a property from a few different angles. These formulas give you different angles to evaluate this property you're looking at. And don't expect the first deal or 2 or 10 or 20 to be that off the charts great. You're going to probably have low numbers, and that's okay. But the point of this is just to practice, to go through the motions. And then after you get an income snapshot, you're going to estimate the full value of the property, and you're going to try to figure out what this property is worth, as a resale value. And so you can use Zillow, you can use some other estimates online to do that as well. And so by doing that, though, you can figure out the equity potential. Like, what is the current asking price of the property, and what's it potentially worth? Or maybe I could make an offer that's a little bit less than this property is asking, because it's been on the market for 90 days or 180 days, and potentially they would take a discount. And so you're going to figure out ways that you can make money on the income, you're going to make money on the equity, and you're going to practice that, and you're going to do it over and over again, just like you were shooting basketball, or just like I was coaching you in sports. You got to practice this to get better at it. But over time, you become more comfortable, you become more confident, so that you can buy your own properties, and you can confidently put your money into a deal and say, I'm going to make money on this deal, or have a good chance of making money. So remember, if you want to increase your confidence and practice using back of the envelope analysis with your own rental properties, I have a free cheat sheet that you can download. There'll be a link in the podcast and YouTube description below. And if you really want to see how all of this comes together and you apply it to a real rental property, I want to recommend my next video where I analyze a duplex property. This is a real property in my market, and I go in depth and show you all of the analysis, what I would have paid for it, whether I thought it was a good deal or not. And so if you want to see how it's all applied in the real world, that is a great video to watch. It's been one of the most popular videos on my channel. There'll be a link above me here if you're watching on YouTube, or you can also click on the link in the podcast or the YouTube description below. Let me know in the comments how this landed with you, if this was helpful for you, how you're going to use these back of the envelope analysis to do your own properties. And if you have any other questions or comments, I'd love to hear from you. And best of luck with your own rental properties, and hope to see you soon.